Great to see you, Robbie. And as always, you're looking very tidy, unlike the rest of us who are growing beards. Robbie, for those of you who don't know, is one of the better dressed investment managers we've got at Fisher Fund. So it's good to see he's sticking with it at home.
If only, Frank.
Yeah, it's true. It's true. As much as he may deny it, he's a very nicely turned out young man. Robbie, while you've been sitting at home, one of the things you've been doing a lot is talking to the companies we invest in and trying to get a sense of how management teams are navigating their way through the environment we're in. What are the key themes from those calls, and maybe some examples you could share with us?
We've undertaken, over 50 calls with our management teams in the last few weeks. A key focus of those calls has been just on the balance sheet strength of companies. All companies, are in the process of shoring up their cash reserves and making sure that they can cope with significant revenue downturns. And our companies have been no exception. In addition to that, we've, been reasonably pleased and surprised at just how well the companies are coping in what's an arduous environment. If I use Ansell as an example, they're a global manufacturer of gloves and protective equipment, which is critical for the healthcare space right now, and they're also used in industrial projects and in automobile manufacturing plants and so on. And they've managed to keep their global operation up and running despite various parts of it being in various states of shutdown. They, for example, in situations where they've had to close warehouses down because somebody has got coronavirus, they've managed to do that, protect their employees, shut the warehouse down, clean it up, and have it back up and running within 3 days. And as a consequence, they've come out now and actually reaffirmed guidance that they gave prior to coronavirus impacting their operations, which has been very supportive to their share price.
That's super impressive. It's a lot of Zoom calls, right, to keep the business running. Yeah.
That's right, because you spot on. They've had to do this remotely and find ways around the challenges that coronavirus provides them using, as you say, Zoom. In addition to that, the companies are going out of their way to make sure that their clients are in a good space. And so we've seen, for example, Car Sales and Seek both provide, and both of those companies are in the online advertising space. Car Sales for cars getting sold online and advertised online, and Seek, they're in the employment and recruitment space for people looking for jobs. And both of them have provided price concessions to their customers during this period of shutdown in Australia. For us, that's a very good sign because I guess both of those companies are focused on generating value in the long run. And cutting your customers off at the knees when they need you is not a good way to do that. So it's pleasing to see them working hand in glove with their customers to make sure that we can all come through this crisis better and stronger than we would otherwise be.
Certainly, smart long-term decision making just seems to be one of the keys to survive and thrive in this environment. Obviously, with those phone calls you've made and prices moving around a lot, can you just give us a flavour of some of the things you've been doing in portfolios to position yourself both for the now, but also to make sure you're well positioned for when markets eventually rebound?
A number of share prices across our portfolio have fallen quite markedly. And so we've used this as an opportunity to gently and carefully reweight our portfolio in favour of those companies that we think are in the higher quality end of the spectrum in our portfolio, and post these share price falls offer significant upside when and as the economy recovers. So we've increased our share weightings in the Australian banks, for example, and we have selectively topped up positions such as Seek and Credit Corp. We've funded those top-ups through, I guess, reducing positions in companies that either offer less upside in terms of where they're currently trading. They might not have fallen as much through no fault of their own, but consequently offer less upside, or companies that have, I guess, lower durable competitive advantage positions in the industries in which they operate in. By doing this reweighting, we think we are strengthening the portfolio to keep managing through this crisis, but equally positioning it for strong upside when the recovery does come. And then secondly, affiliated with this, we've been keeping our eye out for opportunities in the market. And to that end, we have added recently a position in REA, which is an online real estate advertising company in Australia, to the portfolio.
Cool.
Historically, REA has traded very expensively, and in the sell-off, it's given us a rare opportunity to add it at a reasonable price.
I was intrigued by your comment on the banks there, and you lived through the global financial crisis as I did, and the banks were in a different place then than they seem to be now. So I was interested in reflecting on how this crisis might be a bit different than 2008, and then how does that affect your thinking about the banks and in fact the fact you've added to those recently?
Yeah, so the banks, are in a very different position to what they were in 2008 and 2009, both in terms of their own funding position, as well as in terms of the areas of the market that are being impacted by this crisis versus the crisis in 08 and 09. So I guess a few key differences between the banks then and now. Back then, from a capital standpoint, the permanent capital sliver of their balance sheets, banks were sitting at about 5 or 6% of capital as a percentage of risk-weighted assets back then. That is more than double that today. So they've spent the last decade, post the financial crisis, building up the capital levels, and they are sitting well above, 10% today. The funding mix that they had back then was also quite heavily weighted proportionately in favor of global debt markets. So the deposit base has made up about 50%, 52% of their funding requirements back in 08, and the balance came from global debt markets, which seized up and caused all manner of problems for them in 08. Again, they've learned from that, and today they've built up their deposit bases. Today make up about 70% of their funding requirement, and only 30% from global debt markets. Then in terms of the exposure side, back then in 2008, banks had, quite a large exposure to companies that were struggling from being over-levered, companies in the property space and the mining space. They tended to have big loans out to those sorts of businesses. Today, the most acute parts of the economy that are being affected involve travel and leisure and services businesses, which are a far lower proportion of their lending books today than they were back then. So they're less exposed in that sense from a risk perspective. And then lastly, the government and the RBA and the fiscal and monetary policy response has been far greater, and it's come far sooner this time around than we saw in 08 and 09. So there's a lot more support and ballast, which helps, I guess, support the banks as well as the economy through this crisis than we had back then.
That is a super important difference, isn't it? Because if the banking system begins to fray, that usually speaks to much longer, more pronounced and more difficult markets than if the banking system stays robust and things look a whole lot better in 2020 than they did in 2008. It's one thing we could be thankful for at the moment.
It is one of the reasons that we're more constructive on the banks than we would otherwise be. In the scenario that we find ourselves in now, the banks have worked very closely with the RBA and with the government and with the prudential regulator, APRA, to ensure that system works really well. So if I think of the funding side, for example, the RBA, in addition to the banks having very strong funding options in front of them because of this increased weighting to deposit-based funding, the RBA has stepped in and provided them with an additional term funding facility, which gives them access to borrow from the RBA for 3 years at 0.25% per year. And the banks, in speaking to them last week, they are going to use that facility, and it just gives them an extra funding option that they wouldn't otherwise have. APRA, for their part, which is the prudential regulator, have said, the banks are in a good shape from a capital position, and they are willing to let the banks run that capital position down somewhat, which again increases the flexibility for the banks to operate in this environment. And then on the other side of the ledger, on the lending side, businesses and households are going through quite a bit of strain right now, and the government in Australia has stepped up with over $200 billion worth of stimulus to help provide support to households and businesses. That is about 10% or close on 10% of GDP. And again, if we compare it to 08, the total fiscal package in 2008 was about $50 billion. So this is more than 4 times the amount that we saw, more than a decade ago.
Wow.
Key amongst that is a $130 billion fiscal package known as the JobKeeper package, which is a direct payments that the government is going to make to businesses to help keep people employed through this period of economic hibernation. And all of that will feed back into lowering, the default rates and the bad debt charges that banks will incur, and that in turn, I guess, allows them to keep functioning and working well.
Virtuous circle going. You mentioned REA Group there. I think all of us Kiwis, we love houses, we love buying and selling them, we love seeing what's going on in the market. Can you just give us the 2-minute synopsis on why REA is a great business to include today?
REA, it's the dominant online advertising platform for houses in Australia. Approximately just under 100% of all real estate agents across Australia, when they advertise houses for sale for people, they put them on the REA website. So it benefits from a very strong network effect mode, what we refer to as a network effect mode, whereby anybody trying to advertise a house has to go onto the website to advertise it. Anybody trying to buy a house needs to go onto the website to look for houses, because that's where they're all advertised. And again, you get a virtuous circle there. REA is obviously going to go through a tougher period now than they've had in the last few years, because the number of houses that are being transacted in a period of shutdown obviously falls. But ultimately, people are going to have to transact houses. They're going to buy and sell houses, and when they do, and that market comes back, they're going to be doing so on the REA platform.
Buy great long-term assets at on-sale prices, once in a lifetime chance kind of thing.
Correct. And, it's March, with the share price having come off with the market, it offered us a rare opportunity to do so at what we thought were opportune prices.
Robbie, the last question I wanted to ask you was the same one that I asked Ash, actually, that through difficult times like this, how is it that you get confidence to put capital to work, to make good quality decisions, and to get your head out of the short term and into the long term? How from a mindset point of view, do you manage yourself and your team through this environment?
First step is, we focus very much on our process, and I guess our process is geared towards finding companies that are high quality companies that do have strong, durable, competitive advantages to their business operations. That in and of itself provides ballast to those businesses to withstand shocks like coronavirus or economic downturns, and gives us quite a bit of comfort. Businesses that, do have strong economic moats and strong growth runways in front of them in 5 or 6 years' time, will, we think, pay their way for us. So that gives us comfort. And then secondly, just speaking to the businesses that we're invested in, I alluded to, what Ansel are doing earlier. The actions that they're taking, the dexterity that they're showing in dealing with this, pernicious coronavirus is really, to be applauded, and they're finding a way through it. They're finding a way to keep operating, to keep functioning, and working with their clients. And that in and of itself just gives us comfort that they will do what it takes to get through this. And when they do, given that they are high quality businesses, we think they'll be well placed to grow thereafter. But it comes back to our investment process, and we try not to be caught up in the near term. Share price volatility can certainly make you question your sanity at times, but we try and put that to one side and just think about the characteristics of these businesses and where they might be in 4, 5, 6 years' time.
Very good. Hey, Robbie, keep that sanity. Thank you so much, and enjoyed the chat. Thank you.
Thanks, Frank. Take care.